Wall Street doesn't make money from stocks. It makes money from decisions, from reactions, from people doing something. Calm investors are quiet. Quiet investors don't trade, and that's bad for business. So the system isn't built to reward patience. It's built to reward activity. Fear creates urgency. Urgency creates trades. Trades create profit. This isn't corruption. It isn't a scam. It's the business model. Wall Street doesn't trade stocks. It trades you. Most people enter the stock market believing a simple story. You work hard. You save money. You invest responsibly. You buy companies you believe in. You avoid obvious risks. You wait patiently. And over time, the market rewards you. In this story, Wall Street is just infrastructure, a neutral place where buyers and sellers meet, a system designed to be fair, efficient, and logical. If you win, it's because you made good choices. If you lose, it's because investing involves risk. That story sounds reasonable. It feels mature. It feels honest. And that's exactly why it survives. But it leaves out one detail, a detail that changes everything. Wall Street does not get paid for outcomes. It gets paid for activity. When you buy a stock, your money doesn't disappear into the company. It moves through systems, exchanges, brokers, market makers, clearing firms. At every step, something small is collected. A spread, a fee, a routing advantage. Individually, you barely notice it. But multiplied across millions of trades, it becomes enormous. And here's the key point. Those systems get paid whether you win or lose. They get paid when you act. The faster you act, the more often you act, the more valuable you become. This isn't hidden. It's structural. Now imagine two investors. The first investor buys a diversified portfolio. They ignore headlines. They don't react to daily price moves. They hold for decades. This investor might do very well, but for Wall Street, they are almost useless. No trades, no reactions, no engagement. Now imagine the second investor. They check prices every day. They follow financial news closely. They feel anxious when prices fall. They feel confident when prices rise. They adjust constantly. This investor might struggle, but for Wall Street, they are extremely valuable because every reaction creates movement, and movement is the product. Volatility scares investors, but it excites markets. When prices move slowly, people lose interest. When prices swing wildly, attention spikes. Fear creates urgency. Urgency creates action. Calm markets feel boring. Chaotic markets feel overwhelming. One rewards patience. The other rewards participation. The system doesn't prefer stability. It prefers engagement. Markets are driven by information. But not all information is equal. Facts matter. Data matters. But stories matter more. Headlines don't exist to make you smarter. They exist to make you react. Markets surge. Stocks collapse. Investors panic. Opportunities disappear. These aren't lies. They are emotional triggers. They compress complex systems into simple feelings. Fear, confidence, urgency. And once emotion enters, decisions follow. Retail investors aren't irrational. They're human. Humans are wired to avoid pain, to seek certainty, to follow crowds. That makes behavior predictable. People buy after prices rise. They sell after prices fall. They enter late. They exit early. Not because they're foolish, but because emotions move faster than logic. Large institutions understand this. They don't predict the market. They observe behavior. Every trade carries information, not just about price, but about psychology, where people are confident, where they are afraid, where pressure is building. Markets don't just process prices, they process behavior, and behavior leaves patterns. Zero-commission trading changed everything. It removed friction. It removed hesitation. When something feels free, people use it more. More trades, more reactions, more data. The system adapted. It always does. Technology makes investing feel powerful. Clean apps, smooth charts, simple buttons. It creates the illusion of control. But simplicity doesn't change incentives. It only lowers resistance. The easier it is to act, the more often people do. Most people think investing is about being right, picking the right stock, timing the right moment, making the right move. But Wall Street isn't playing that game. It's playing a volume game. It doesn't need you to win. It needs you to move. Market crashes feel catastrophic. For investors, they are. But for the system, they're stress events. Activity spikes, volume explodes, attention locks in, fear concentrates behavior, and behavior drives profit. This isn't a moral judgment. The system isn't evil. It's efficient, optimized for the people who designed it. Once you understand incentives, everything makes sense. The most dangerous thing in investing isn't risk. It's misunderstanding the game. When you think you're trading stocks, but the system is trading you, you'll always feel behind. Because the game was never designed to reward patience. Wall Street doesn't trade companies. It doesn't trade charts. It doesn't trade predictions. It trades behavior, your attention, your reactions, your decisions. And once you see that clearly, you stop confusing movement with progress. Wall Street doesn't trade stocks. It trades you.